Good afternoon, students. I hope all of you are doing good and I hope your preparation is going fine. Welcome to today's Analyst. This is 12th of December 2023 and we are here to discuss important articles from the Hindu and the Indian Express. Now, the handout of the session is there in the description box. You may utilize it to streamline your current affairs preparation. Now, coming to the table of contents. The first topic and the very important one is related to Article 370 and yesterday's Supreme Court verdict on it. Second topic is related to your old pension scheme. Again, an important topic. Third topic is related to inflation, particularly your wholesale and retail inflation. Fourth topic is related to foreign portfolio investment and foreign direct investment. Last but not the least is your PM Ujjwala Yojana. So let's start with the first topic. Okay, students, so coming to the first topic. The first topic is related to Article 370 and the Supreme Court verdict of yesterday on this particular Article 370 and the abrogation of it by the central government. Now that is why it is news, but why it is important for our syllabus and for our examination is that in our General Studies paper 2, Indian Constitution, historical underpinnings, evolution, features, amendments and significant provisions have been mentioned. So in this respect, this particular topic becomes very, very important. Now, yesterday itself, one of the faculties in this analyst only has covered the basic things or basic things which you have to know about Article 370 and the recent things or recent evolution happening around Article 370. So today, we'll be particularly talking about the Supreme Court verdict only, right? So first of all, telling you about this verdict. So a 5 judges constitutional bench was made. And that bench was led by the Chief Justice of India, the current Chief Justice of India. And that constitutional bench gave a 5-0 unanimous ruling on this particular article and the abrogation by the central government. And they upheld the abrogation of Article 370 by the central government in 2019. So, discussing about the different facets of the verdict, let's discuss different things and what all Supreme Court gave as a verdict in this particular sentence. So coming to the first part, that is the unique and special status of J&K. Now Supreme Court categorically pointed out that J&K is having no sovereign element after the 1947 accession of J&K into our country. Now Maharaja Hari Singh, the erstwhile Maharaja of J&K, he gave a proclamation which said that even after accession, the J&K will retain its sovereignty. But his successor, Karan Singh, right, he gave another proclamation after many years later and said that proclamation said that Indian Constitution will prevail over all the other laws in J&K. So which tells us that J&K is an integral part of our country and Indian Constitution will be supreme in the state of Jammu and Kashmir. And the merger of J&K into our country will be treated like the merger of every other princely states into our country. That is what Supreme Court said. So yes, J&K is an integral part of our country. And if you see the Article 3 of J&K's constitution, which was earlier present, it categorically said that the state of Jammu and Kashmir is and shall be integral part of Union of India. So Supreme Court said that only because a state is having its own constitution or a different constitution, it does not define a special status. And the purpose of that particular J&K constitution was to ensure everyday governance happening in the J&K is run in a smooth way. So to ensure that the governance is smooth, run effectively and efficiently, J&K got a special constitution, but that in no ways gives it a special status. And Article 370, it integrated J&K with that of India. So that is what Supreme Court rulings tells us. Now coming to the statehood restoration topic, on which also Supreme Court talked about. Now Supreme Court said that the reorganization of erstwhile state into a union territory which happened in 2019 was a temporary move made by the central government. And it has also directed the central government and the center and the Election Commission of India to restore the statehood. So central government will restore the statehood and legislative assembly elections to be held as soon as possible in the J&K union territory currently by the Election Commission of India. So that is what Supreme Court has given as a direction. Now, Article 370, is it a temporary or a permanent provision? Now, this question also have been answered by the Supreme Court. So, Supreme Court has said that Article 370, it's a temporary and transitional provision. So, it's a temporary and transitional provision which served the purpose only in warlike situations, and warlike situations were prevailing in the state of J&K in 1947. So only in those circumstances this Article 370 served a purpose, and it is temporary as well, and it is a transitional provision as well. That is what Supreme Court of India has very categorically and clearly stated. Now coming to the effective abrogation of Article 370. Now, Honorable Supreme Court of India has upheld both of the presidential proclamations which came on August of 2019. So they have upheld both of the presidential proclamations. And it included one of the proclamation which said that the Constituent Assembly of J&K will be treated as a Legislative Assembly of Jammu and Kashmir. So giving the new meaning to the Constituent Assembly of J&K as a Legislative Assembly of J&K in 2019. That was one of the proclamation, and Supreme Court has upheld that as well. But now the central question in front of Supreme Court was that whether the actions taken by union government or whether the actions can be taken by the union government assuming the powers of the state when it is under president's rule. Now the question in front of Supreme Court was that the actions which were taken by the union government, could they be taken by the union government by assuming the powers of the state if the state is under president's rule? Now to solve this particular question, Supreme Court of India referred to the 1994 landmark ruling of S.R. Bommai versus Union of India. So this S.R. Bommai and Union of India, it's a landmark ruling which came in the year 1994. And this particular ruling dealt with the powers and limitations of the governor under president's rule. And under this S.R. Bommai versus Union of India, Supreme Court in 1994 ruled that Supreme Court held that the governor can assume all or any of the rules of the state legislature when the state is under president's rule. So yes, governor can assume all or any roles of the state legislature when the state is under president's rule. That was what was held in S.R. Bommai versus Union of India case. And by referring to this particular case, this particular judgment, the Supreme Court now yesterday held that, and it gave an interpretation. Relying on this particular interpretation, they said that there is no prima facie case that the president's orders were malified or extraneous exercise of power. And that is why they upheld both of the presidential proclamations of August of 2019. So all in all, the abrogation of Article 370, some provisions of Article 370 done by the central government of India in August of 2019 were upheld by the Honorable Supreme Court of India yesterday. Now this is a very, very landmark judgment, and if you want to know the background story behind it, how it evolved, and over the years what steps were taken, you can refer to the yesterday's analyst, and the faculty has covered all the things, the background story in that particular analyst. Now coming to the second topic of today, again that is very, very important. So a recent report by the RBI has said that returning to old pension scheme by different states can put heavy burden on their finances. Now why it is important for us? Because in our General Studies paper 3, Indian economy and issues relating to it, this old pension scheme and new pension scheme are important issues. Because many times in news also you must have heard that many states are moving back to new pension or moving back to the old pension scheme, right? And that is why this understanding what is this old pension scheme versus new pension scheme, it is imperative for us. So while understanding old pension scheme, the comparative analysis of old pension scheme and new pension scheme is very important for us to understand, right? That is why I have divided this particular segment into old pension scheme versus new pension scheme. So while we are understanding old pension scheme, we'll be comparing it with the new pension scheme as well. That how it is different with and how it is different in context of new pension scheme. So first of all, the type of scheme, that what type of scheme this OPS and NPS are. So old pension scheme, it is a defined benefit scheme. So it is a defined benefit scheme. That is, benefit will be given to the person. And this new pension scheme, it is a defined contribution scheme. So that person have to contribute to this particular scheme. Now implementation period. Now before 2004, this old pension scheme was implemented. Now in 2004, this new pension scheme came into existence. And many years later on, this new pension scheme was open to all sector employees. Now, who can join or who is eligible to join this particular old pension scheme? Now, it was existing before 2004. So, and before 2004, the government employees recruited before 1st of January 2004 are eligible to join for old pension scheme. And who can join the new pension scheme? All citizens of India who are working. They are eligible to be joining for new pension scheme. Now, the most important part about employees' contribution. Now, first thing you would understand that this old pension scheme, new pension scheme, both are the schemes providing pension to the people, providing pension to the employees after their retirement. That is the primary motive of both of these schemes. But both of the scheme, the primary difference lies in the mechanism. That in what mechanism old pension scheme provides the pension to the employees, and in what mechanism, what is the different mechanism in which NPS provides the pension to the employees, right? And the biggest difference is the employee's contribution part. That means in the old pension scheme, I as an employee do not need to contribute anything into this particular scheme. And why I need not contribute? Because the pension which I'll get from the government will be the 50% of my last drawn salary. So whatever salary I'm drawing, for example, let's say I'm the age of 60. And at the age of 60, when I retire, my salary was, let's say, 1 lakh rupees. So automatically, and I'm a government employee, of course. So let's say my salary is 1 lakh rupees. So in the other year, when my pension starts and I retire, government will be paying me 50,000 rupees, that is the 50% of my last drawn salary, plus any dearness allowance. Dearness allowance is the allowance given to cover the inflation expenses, right? So 50% of my last drawn salary plus dearness allowance, that is what the government will be giving to me, right? But in new pension scheme, the pension which you will be receiving, it will be market linked returns. So the returns on your pension will be linked to the market. And it's in this new pension scheme, it's not that government will be providing you all the pension. In the years which you are working, throughout your working years, you have to give 10% of your basic salary plus a DA, that is dearness allowance. So 10% of your basic salary every month will be deducted plus your dearness allowance and it will be created in a form of a fund, right? And from that fund, it will be of course linked to the market, and from that fund you will be getting pension after you retire. Government also will be contributing some portion of it. That is 10% if you are putting, government will also proportionately put some money into that fund. But the government will not be bearing all the expenditure for your pension. That is the primary difference between old pension scheme and new pension scheme. So let me tell this one more time, that in old pension scheme, government to the government employees, government will be solely responsible for the pension. And the pension will be 50% of the last drawn salary plus dearness allowance. In a new pension scheme, government is solely not responsible. But your monthly salary, some part of it, that is 10% of the basic salary of yours, will be deducted every month. And from that a corpus will be created. And from that corpus, from that fund, the pension will be paid to you after you retire. So these are the two different mechanisms between old pension scheme and new pension scheme. So this old pension scheme, is it giving you guaranteed return? The answer is yes. But this new pension scheme, is it giving you a guaranteed return? The answer is no. Because if you don't contribute, you will not be getting any money in this new pension scheme. Now, are you getting tax benefits in this old pension scheme? The tax benefits which you get are very, very less and probably not much. But in this new pension scheme, of course, you are getting tax exemption on your contribution up to 1.5 lakh under the section of 80 CCD, subsection 1, right? Now, also one more thing. Is there a flexibility to switch funds? The answer in old pension scheme is no. Why? Because old pension scheme, any which way no fund is created. Government is providing you the pension after you retire, 50% of your basic salary. The last one, salary. But is the switching of funds required or available in the new pension scheme? Yes, of course it is there. And the lump sum amount, how much you can withdraw at retirement. So you can withdraw close to 60% of the corpus in your old pension scheme. In new pension scheme, close to 40% of the corpus, and then you create it in the form of other portion you create it in the form of annuity. Now, annuity is again a financial instrument, right? Death benefits, that if your death occurs in this old pension scheme, the family gets pension up to 50% of the last on salary. If the death is not occurring, you will be getting 50% of the last on salary in old pension scheme. But if the death occurs, the family gets it. And if you get disabled, then the disability pension will also be 50% of the last on salary. But in the case of this new pension scheme, pension to the nominee based on accumulated corpus. That how much the corpus you have accumulated, on the basis of that only the family would be getting pension after you die. And pension to the nominee based on accumulated corpus, again in the case of disability provisions as well. That if you get disabled, your nominee will be getting again from that corpus only the pension. So whatever you put, right? Similarly, the return you will be getting in this new pension scheme. In old pension scheme, that was not the case. And that is why you will see that the overall risk in old pension scheme, it was low and close to negligible. But the overall risk in new pension scheme, it is very, very high, right? And also if you see the pros of it, the pro is guaranteed income under retirement and no investment risk. So there is guaranteed income or a guaranteed pension to the person who is under old pension scheme. Because person would be knowing that if I retire, 50% of my last on salary any which way will be given to me. Right? That is a very big pro of it. Another pro is that no investment risk is there. Right? But what are the pros of new pension scheme? You can get tax benefits. There is portability, market-linked returns, right? Which are of course not very lucrative to the employees. And what are the cons of the old pension scheme? Of course, there were cons. That is why it was changed. And the biggest con was high burden on government finances. So on the government exchequer, there was very high burden because of this old pension scheme. Because what was happening? Ultimately, government was the one who was spending money in this old pension scheme. In this new pension scheme, employees have to contribute, right? So what is the con of this? That uncertain returns, the market risk, and the lower pension compared to old pension scheme, and the burden on the employees. That employees' the salary is getting less, salary is getting deducted every month to form that corpus. That is the primary thing under this new pension scheme, right? So I hope this old pension scheme and new pension scheme, the analysis part of it, it is very clear to you, particularly the old pension scheme. That what was so good with old pension scheme that many states are again moving back to old pension scheme. The biggest reason is that employees believe that in old pension scheme, we were assured of our return. We were assured of our pension. That at whatever salary we retire, 50% plus the dearness allowance, any which way we are going to get. That is the biggest pro of old pension scheme. And that is what employees want. And because employees want this, that is why many states are moving back to old pension scheme. But what RBI has said recently is that if you move back to old pension scheme, it will have a very, very heavy burden and a very, very heavy impact on the state's finances. Because it is having an impact on the government exchequer, because government is eventually the one who will be paying under this old pension scheme. So I hope this is very, very clear to all of you. The third topic is related to inflation, particularly your retail and wholesale inflation. Now, why this is in news? Because our finance minister has recently indicated that retail inflation in our country has stabilized. And why it is important for us? Because again, GS paper 3, Indian economy and the issues relating to it, inflation is very, very critical and important. Now, why this retail inflation has become stable in the recent years? Because the India's retail inflation has declined from an average of 7.1% in the last year, 2022, from April to October, to 5.4% in this particular year, that is 2023. So in the same period from April to October 2022, the retail inflation was 7.1%. But the current year, 2023, the retail inflation is 5.4%. So our retail inflation in a way has stabilized. Now, is the data important for you? I will say probably not. Because the yearly data is the most important data which you should remember. These data, you should just know the trends, right? So what we'll be covering in this particular topic is what is retail inflation, what is wholesale inflation. But to start with that, first thing which we have to know is what is this thing called inflation. Now, many people associate inflation with rise in prices. So, rise in prices of goods and services in economy, that is inflation. But there is one word which people miss, and that word is sustained, right? So inflation only happens whenever there is a sustained rise in prices of goods and commodities in a particular economy. That is what your inflation is. Now the question is, how do you measure inflation? Now to measure inflation, you first of all take a basket of goods or services. You take a basket and then you judge their prices or you analyze their prices. That this particular basket of goods and services, the prices are going up or the prices are going down. That is how you will be able to measure inflation. Now, how to do that and the basket of goods, from which perspective we should measure the inflation, in that respect, it is divided into two. That is wholesale inflation and retail inflation. Now, to calculate wholesale inflation, a index is there. Now, index is nothing but the way to calculate inflation. Now, to calculate inflation from the wholesale level, wholesale means that is from the perspective of the producer. From the perspective of the producer, that is the wholesale transactions and wholesale businesses where the goods are being sold at bulk, right? So from their perspective, if you want to calculate how much the rise in price is there, you will go for this wholesale price index, right? So very simply speaking, this wholesale price index takes into account the inflation level of wholesale goods. That is goods sold at bulk, right? And it is from the perspective of course, the producer, right? Now, this wholesale price index, it is calculated by your Office of Economic Advisor, Ministry of Commerce and Industry. You should remember that for prelims, it is very, very important. And one more thing which is very important, that only goods are taken into account in this wholesale price index, and it is not including the services, because you only tell me that is it possible to calculate services at wholesale level? Services are usually provided at individual level. That is why in wholesale price index, the services are not included and only goods are included. Now coming to the base year, that what is the base year in this wholesale price index? Now earlier the base year was 2004-05 and it has been revised to the year 2011-2012. Right? So currently the base year is 2011 and 12. And this also you know that it only calculates the goods sold and traded in bulk by the wholesale businesses. That is your wholesale price index, and the inflation which this wholesale price index calculates is known as your wholesale inflation. I hope this is very, very clear to all of you. Now from the other lens, that is from the lens of consumers. Now, from the lens of consumers, that is, we are buying the good, we are consuming the good, right? From our lens, once the inflation is calculated. Earlier, we were calculating from producer's lens at wholesale. Now, we'll be calculating at consumer's lens at retail prices. So, we'll be focusing on retailing prices. That is the price in the retail stores, retail shops. How much those prices have increased over time. That index which we use to calculate this particular retail inflation is known as consumer price index. So consumer price index is calculating what? It is calculating retail inflation. Now it is calculated by your National Statistics Office and it is having the subgroups, the basket of commodities which I told you. So there are various subgroups of this consumer price index. First subgroup is your food and beverages. Second is your fuel and light. Another one is your housing and clothing, bedding, footwear, and also other commodities. So all these commodities comes under your consumer price index. And one more thing, it is from both goods and services perspective. Wholesale price index only goods, this consumer price index both goods and services. And the base year of consumer price index is 2012. And the base year of wholesale price index, it was 2011 and 12. Right? And perspective of retail buyer is taken into account under this consumer price index. I hope this is very, very clear to all of you. Now, what are the four types of consumer price index? That is very important for us to understand. What are the various types of CPI? Because CPI we generally use as a single term. What is consumer price index? That in general we are talking about CPI rural, urban and combined. But there are other different types as well. That is your consumer price index, particularly for one set of workers, that is industrial workers. Another CPI is for agricultural laborers, that is laborers who are working in agriculture. From their perspective, how much the prices have increased of goods and services, and also from the perspective of rural laborers, right? So the laborers who are working in rural areas, not the agriculture ones, right? So the first three, that is industrial workers, agricultural laborers and rural laborers, the first three CPIs, they are compiled by your Labor Bureau of a Ministry of Labor and Employment, right? And the last one, that is your CPI, it is calculated by your NSO, Ministry of Statistics and Program Implementation, that is your MOSPI. So here also we saw now that the CPI is particularly calculated by your NSO. So we were talking about the CPI rural and urban and combined, right? But the other forms of CPI also exist and they are calculated by Labor Bureau of Ministry of Labor and Employment. Now the base year of this industrial worker CPI, the base year is 2016, and for this particular CPI, the base year is 2012. I hope this wholesale and retail inflation and this wholesale price index, consumer price index is totally clear to all of you. Okay, so coming to the second last topic, it is related to foreign portfolio investment and foreign direct investment. Now the Sensex and Nifty, that is the two stock exchanges of our country, they have reached a new high recently due to the higher foreign portfolio investment inflows into our country. So due to many foreign portfolio investors investing money into our country, Sensex and Nifty, that is the stock exchanges of our country, they have reached new highs, right? So they have grown. Now again, for our general studies paper 3 perspective Indian economy, this particular topic is important. Okay, so let's understand what is the basic difference between foreign portfolio investment and foreign direct investment, right? FPI, of course, all of you know it means foreign portfolio investment. FDI means foreign direct investment. Now let's understand FPI first. So FPI, portfolio investment, it refers to investment in the stocks, bonds, or any other assets which are available in the stock exchanges in order to get a quick financial gain and short-term returns. So foreign portfolio investors, they invest in order to get short-term returns, in order to get financial gains, and they usually invest in the stock exchanges. So they usually buy stocks, they usually buy bonds, or any other assets which are there in the stock market. Then what is FDI? What is foreign direct investment? Now, foreign direct investment involves investments into the large MNCs, into the large institutions, and they're done by the large venture capitalist firms for a strategic interest in that particular country. That is, strategic interest in that particular country and company, right? So in FPI, portfolio investment, the investment was done in stocks to get a quick financial return, right? To get financial return and quick returns, right? Short-term returns. But in FDI, due to certain strategic interest in that company, interest in that country, investment is made by the large MNCs. It's made by the large venture capitalist funds, right? And the major rule is, the major difference is that it is for long term and it is more favorable for a country. Because FPI's portfolio investment, they are usually volatile and they are usually for short term. So your investment banks, financial institutions, private equity players, they are also involved in this portfolio investment, right? And since they are institutions, so one type of portfolio investment is your foreign institutional investment as well, which we have written here, right? It's one of the subtype of foreign portfolio investment only, right? Now what happens in foreign direct investment? Direct, FDI, right? If the person, or let's say FDI, the large company, they're investing largely into another country's company, in order to have a strategic interest, of course, they will be actively involved in their operations. They will be actively involved in the decision making of that company. So those who are making the FDI, direct investment, they usually get involved in the decision making and in the operations of that particular company in which FDI they are sending. But FPI, portfolio investment, they are usually passive involvements, right? So passive investments, they don't actively involve into the operations. They passively involve themselves, right? That is at a dormant level. So what are the examples of it? The example is, for example, HSBC fund or HSBC bank. They're investing in Indian markets, Indian stock markets on the behalf of Tom Cruise and Cristiano Ronaldo. That is a very classic example of your foreign portfolio investment, right? But FDI, now in what forms they can be done? First discuss that. That they can be done in the form of a joint venture, that you are jointly starting a venture in a particular country, right? In a particular business. Merger or acquisition, you are merging your company with some other company of that nation, or you are acquiring certain company of that particular nation, or you are having a subsidiary company. The biggest example is that in 2018 when Walmart acquired 77% of the stakes in Flipkart as an FDI investment. That is the classic example of foreign direct investment. And also one more example is the Canada Pension Fund. Canada Pension Fund investing and buying shares in the IPO of several Indian companies, for example, your Paytm, Zomato, FSN e-commerce ventures, that is your Nykaa, and PB Fintech, right? So this is particularly your foreign direct investment. Now, foreign portfolio investment, we know that it's having quick return orientation. It can be quickly bought and sold, easily bought and sold. That is why it induces volatility. So FDIs are usually preferable by the countries. A country would prefer more FDIs rather than FPIs. Because foreign portfolio investment, they are usually volatile, and foreign direct investment, they are more stable. And they are there because of some strategic interest by another country's company into our country, right? I hope this is very, very clear to all of you. Now coming to the last topic, but very important topic, that is Prime Minister or Pradhan Mantri Ujjwala Yojana. Now why this is in news is again that the average per capita consumption of the cooking gas under this Pradhan Mantri Ujjwala Yojana has improved significantly over the years. And for your general studies paper 2, welfare schemes for the vulnerable sections, this PM Ujjwala Yojana is very, very important. And it's important from a prelims perspective also. From a mains perspective also, you can use the example of this particular Yojana in a lot of your social justice and social issues answers, and in the governance answers as well. Okay, so let's know a little bit about this Ujjwala Yojana first. So it was launched by our Prime Minister Modi on 1st of May 2016. And what was the slogan? The slogan was clean fuel for better life. So that is clean fuel, better life. That was the slogan of this Ujjwala Yojana. And what was the objective? The objective was to safeguard women and children in particular and their health. So to safeguard women and children's health by providing them clean cooking fuel. So the motive was to safeguard the women and children health by providing them cleaner cooking fuel, that is in the form of liquefied petroleum gas, LPG. Because LPG won't compromise their health, and the women would not be compromising their health in the smoky kitchens and wander in the unsafe areas while collecting the firewood which they earlier used to use as a cooking fuel. So replacing that firewoods which the women used to use, having negative impact on the healthcare as well, removing that and replacing it with the LPG connections for the households, especially for which households. We'll study that as well. But first, before that, let's know the implementing agencies. The implementing agency is the Ministry of Petroleum and Natural Gas. So you might get confused at a lot of places because if you use your common sense, you might think of some other ministry, but in reality, Ministry of Petroleum and Natural Gas is the ministry under this Ujjwala Yojana. Now, what is the budget? The budget is 8,000 crores. Now, what are the features of it? The feature is providing 5 crore LPG connections to whom? That was the question I asked earlier. To your below poverty line families. So the BPL families, they will get close to 5 crore connections in the entire country, with the support of rupees 1,600 per connection in the next 3 years, of course, given by the government, right? So the next 3 years, 2016 to 19, they had the target of 5 crore connections. And the target was revised in the year 2018 to up the connections by 8 crores. So revised to 8 crores LPG connections in 2018. So estimate was revised. And the connections will be, this particular point is very important, the connection will be issued in the name of women of the household. So we see one more aspect here, that is the aspect of gender equality and women empowerment. Gender equality and women empowerment, because the LPG connections will be issued under the names of women, right? Now, eligibility and identification, right? Of course, eligibility is that all the BPL families, below poverty line families, will be allowed, are eligible for this, right? So any adult women of the below poverty line family, they can apply for a deposit-free LPG gas connection. So you will not be getting, you do not need to pay any of the deposit for that LPG gas connection. Now the coverage, the eligibility coverage of this particular scheme was expanded again in 2018. And it started including other women beneficiaries also from 7 more categories. So from the category of your SC and ST, scheduled caste, scheduled tribes as well. Those who are getting the benefit of Pradhan Mantri Awas Yojana, that is the housing scheme. Those are getting the benefit of Antyodaya Anna Yojana, or the women from most backward classes, right? So class also comes here. Women from tea gardens, from the forest dwellers and river islands. So women from all these categories are now eligible for this PM Ujjwala Yojana deposit-free LPG gas connection. And how will they identify below poverty line family? That is important. So they will be using the socio-economic caste census data of 2011. I hope this particular topic is also very, very clear to all of you. And I hope you enjoyed this session. So all the best to all of you. Hope you have a nice day and prepare well. So good luck and thank you all for watching.